The way the market is acting, you can understand if investors are feeling this way.
I need to understand normal.
Well, veteran journalist Herb Greenberg from Herb Greenberg's Red Flag Alerts, he says that not normal is the new normal. And as a result, he's thinking like this.
You know who I really envy? I envy the people who are really able to put on blinders, not be concerned at all about the FOMO, not getting sucked into it. They're true compounders, and they actually can go in. They know the companies they own. Some of them they'll be right, some of them will be wrong, and they understand the valuations. And that's fewer people than most people. Everything else is a matter of, are you a trader and speculator and you want to feel part of the game and you can talk it? Or are you comfortable with a portfolio that may not be as robust?
You'll hear that in our big interview. But what's normal for us is that Thursdays start with Todd Rosenbluth with the ETF of the week. And after that, the normal thing is to have a great interview. And today our book interview features financial planner Jeremy Kyle, author of Retire Today, Create Your Retirement Master Plan in 5 Simple Steps.
Maybe you should start acting a little more normal.
Oh yeah, we are doing what we normally do, which is bringing you great financial talk. This is Money Life for October the 16th. Thank you so much for joining us. The show is up late. That is my fault. It is completely my fault. Do not blame anybody else, including Apple Podcasts. This one's on me. Some things got tied up and that was unfortunate. But the show, other than that, it is, normal. We've got a great show planned for you and executed. And I want to point out that talking about a normal show, well, I made a statement asking you guys, do you like it when we do the longer interviews, shorter interviews, etc.? And I've gotten some really good feedback. I really would like more of it, not because I'm desperate to hear from you, though I love hearing from you, chuck@moneylifeshow.com, but because the opinions were really good. Like most of you are saying, yes, we like it when the interviews run long, but a couple of you are saying, yes, but on the shorter interviews, keep them really tight. And that's kind of where I am. I like it when we do a survey thing or we bring somebody in and we talk about the survey and keep it tight. And by the way, keeping our interviews tight, like we do want to keep our footprint. We do like the radio ethic of, you know that you're tuning in, you know what you're going to get. It's basically going to be an hour and you can plan that time with us. We also like the fact that timing pressure makes me stay on my toes and makes our guests stay on theirs. You can go to a lot of podcasts where they go, so-and-so is the chief investment officer of this. And their first question is like, tell us how you became the chief investment officer. That is not something that is a valuable question. It really is not. Now, you might be curious. You can go find out what they did, but usually you want to know. And we don't spend a lot of time going, oh, and this company has this much in assets under management. I'll mention it occasionally, but you have a pretty good sense that if I've picked somebody to be on the show, I've got a good sense of who they are, and there's somebody you should be hearing from. And it doesn't make a difference if they manage a little bit of money or a lot of money. What matters is their opinion and how you process it and how it relates to you. So that's where I think we want to spend our time or not spend our time. So I do like some of that pressure, but a couple of you said, yeah, the problem is that I love the surveys. I love the talking about that kind of stuff. And that's what tends to go away a lot when we do 3 interview shows. Not wrong. But what I really want to do is make it that maybe the intros are a little bit shorter and that lets us expand other things. And then I'll maybe use other times to say those things that I need to say. But again, I love the feedback and I'd like more of it. If you hitting a touch point for you on, yeah, I like the show, Chuck, but it would be better if, tell me what it is, because there are ways to accommodate almost everything that people were talking about. Like, yes, do more 3 interview shows, let the interviews run longer, but also find ways where we can stick that other stuff in there. I am Chuck Jaffe, financial journalist, your host here. You can reach me at chuck@moneylifeshow.com. This show is independent personal finance talk. There's a lot of stuff going on and you want to know about it. We're going to let you make a lot of the decisions, but we're going to bring you the best guests possible. A lot to talk about. We haven't really done much with China and the trade wars. We'll get more of that potentially tomorrow, maybe next week, but let me also know what you want to hear about. Right now, however, we know you want to hear from our guests and we need to jump into it. So again, Todd Rosenbluth, Jeremy Kyle, really interesting interview. The book is good. We'll have a contest for the book next week. We have a contest for a book now. Rob will tell you about it before we get to the end of the show. And then Herb Greenberg. It's a great day to live the money life. Thanks for being here. We'll prove it to you next.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
One fund on point for today. The expert to talk about it. This is the ETF of the week. Welcome to the ETF of the week, where we get the latest take from Todd Rosenbluth, the head of research at Vetify. You go to Vetify.com, you'll find all the tools you need to be a savvier, smarter ETF investor and to get more details on the new, newsworthy, trending, and timely ETFs that we discuss here. Todd Rosenbluth, great to chat with you again.
It's great to be back.
Your ETF of the week is
The T. Rowe Price QM US Bond ETF, ticker TAGG or TAG.
Tag, you're it.
TAG, TAGG, the T. Rowe Price QM US Bond ETF. And if this one sounds familiar, that's because it is. We don't do too many repeats, but this was the ETF of the week. You tagged this one just over a year ago. So why is this back, and what has changed in a year that makes you want to revisit it?
So this is a bit of a victory lap, not because of how well the fund has performed, although we'll talk about that in a moment. But when you and I were talking about this TAG ETF from T. Rowe Price, it was relatively small. And in the past year, since I looked at it again, it's gathered $1.2 billion. $1.2 billion. It now is roughly $1.4 billion. So essentially, we were early to talk about the fund. Investors embraced it, whether they heard this or they just were looking for a low-cost, actively managed fixed income ETF in an environment that was going to reward such strategies. I guess the audience can determine, but I'm happy to say this fund is much larger. It's doing what it should do, which is slightly outperforming the Bloomberg Aggregate Bond Index in the past year, and I think since inception as well. For people who are looking for active fixed income, given that the Fed is likely to continue to cut rates, we think TAG is a good choice.
You pointed out it is slightly outperforming the index for the last year. It's basically in the middle of its Morningstar peer group. I'm curious, is this story and finding this more about the asset class and what this fund does, or is it more about T. Rowe Price, a serious player in traditional mutual funds that is now becoming a serious player in ETFs? We've talked about some other T. Rowe Price ETFs, and the company clearly, it's not that it's turning away from the fund business, but it is making a much more concerted effort to make a splash in the ETF business. So how much of this, given that the performance is kind of middle of the package, again, slightly better than the index, but still middle of the package, might this also be the result of, like, they got a really good marketing team?
So there's a couple of things in there that you said. Maybe I won't get to all of it. But yes, T. Rowe Price entered the ETF marketplace, I think 5 years ago. It was around COVID when they launched their first, and those were semi-transparent active ETFs. And we've seen money go into those original products. They were originally equity products. But TAG is a slightly newer product. The firm T. Rowe Price has increasingly been committing towards the ETF space in launching newer products, bringing some of their best and brightest into the space. So this is a shout out to T. Rowe Price and the success that they're having within the ETF space. This is a shout out to active fixed income that we've seen punching above its weight. Investors have long turned to active management in fixed income, but they've done so in the mutual fund world. And T. Rowe Price is a firm they might be familiar with in the mutual fund world. This is now a more than, I believe, 3-year-old active fixed income ETF. So it now gets that Morningstar star rating that people still care about. This fund is doing what it should do. It's very cheap at 8 basis points. I'm not sure if you're going to ask me about that, so let me get that out of the way. 8 basis points for active management. So this is different than the AG. It takes sector differences within the bond space, underweighted towards treasuries and overweighted towards almost everything else that you could find within the investment grade bond universe. It's doing what it should do, and I'm happy to be talking about it again.
I did notice the 8 basis point expense ratio. And yeah, that makes it a champ when you call active management and you're paying that little for it. So you mentioned it before I had a chance. You talked about the Morningstar star rating. It is middle of the pack. It's a 3-star in terms of the rating that it's gotten from Morningstar to this point. But again, you're liking the expense ratio, the management, etc. And I'm curious because we are at a spot where we've started a rate cut cycle. We're not quite sure how that's going to play out, but we're expecting more. Bond funds in a rate cut cycle can get a little bit hairy. Typically, you ride it out and they're not hairy at all, but in those moments they are hairy. Can I assume that this is not really a timing call, that you're not doing this because of what you might expect us to hear from Jerome Powell this week?
Correct. This is less of a timing call. This would be a strategic position for people who are considering the TAG ETF and not a tactical one. This is a core bond fund. This is actively managed. So this could do one of two things. This could complement your existing index-based strategy, or if you're a believer in active management, but you've been building a portfolio and overweighting certain sectors or underweighting certain sectors in the bond market, this is a good way to be able to do it. So this is less of a timing play. But you're right. We had our first in a while rate cut in September. We are expecting, and I think the market is expecting, 1 or 2 more before the end of the year, or 25 or 50 basis points, whether that's 1 or 2 cuts in 2 different time periods to be determined. And in times of volatility in the bond market, I like to say people turn to active management. I think that is often the case because you have somebody navigating this and you're not on your own as an individual or as an advisor that's running the portfolios. So if you're not focused on the day-to-day movements of interest rates and the yield curve, the T. Rowe Price team is focused on that and could be somebody to lean into.
And you did mention in there that this could go with if you had an index strategy. If somebody already has an active strategy as an intermediate term core bond fund, this is one of those ones that, it won't really apply to you. We know that ETF of the week is not designed to build the ideal portfolio because it would be way too many funds, etc. But it is that idea that you don't need this if you have an active fund in the same space. You might want this if you're passive in that space.
Yeah. So yes, to the second point, if you're a passive investor and cost conscious as an investor, and that's why you've turned to passive, this can be a good complement. If you are in an expensive mutual fund or an expensive active ETF and it's underperforming, there's always a time to make a swap. And this is a good fund. It's relatively cheap. It's relatively steady and consistent in its performance. So you're not having the swings. So it's not top and then bottom of the deciles in the Morningstar ranking. This is a pretty steady Eddie fund. So we find that around this time in the year, in the fourth quarter, many people are looking to do tax loss harvesting. They've had a position for a while. They're not happy with it, and or they're anticipating capital gains that are going to be coming to them. That is often what happens in the fourth quarter or soon after the fourth quarter. TAG is a great fund, in my opinion, to consider for somebody who's unhappy with what they're getting from their active management. Steady Eddie, low cost.
I love that clarification. I love the information that we got there. And TAG, it's it. TAGG, the T. Rowe Price QM US Bond ETF. Yeah, the fund's so nice, it's now been ETF of the week twice in just over a year, just under twice in just under a year. Todd, great stuff. Thanks as always for joining me.
I'll see you next time.
Todd Rosenbluth is the head of research at Vetify. Go to vetify.com for more information and to use their tools to make yourself a better investor. And of course, Todd in the ETF of the week starts us off every Thursday, and we are just getting started. Later, I will talk with my friend Herb Greenberg of Herb Greenberg's Red Flag Alert. But up next, it's the book interview with Jeremy Kyle, talking about his book, Retire Today. So don't retire from this show now because you'd miss it. Stick around.
Vetify is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at vetify.com.
Did you know that there are at least 23 million American adults who can't read a want-ad?
It's called reading. Top to bottom, left to right. Group words together as a sentence.
Money Life presents
I'm chatting with my guest, author, lecturer.
You get him to open his mind and his future.
The Book Interview.
Give a kid a book and you'll give a kid a break.
That's gonna be radical, Chuck.
Reading is good. Can we start the story now?
We certainly can start the story now, and this is a story that, well, one way or the other, you are going to be living. Because my guest is Jeremy Kyle. He's a retirement planner with Kyle Financial Partners. He is the author of Retire Today, Create Your Retirement Master Plan in 5 Simple Steps. And whether you are building for retirement that is way off in the future, whether you are pre-retiree like I am or what have you, or whether you are just wondering what the day is, there will come a day where today is the day, and you don't want to get there having not properly prepared. This book is going to help you do it, and it's a really interesting, easy read. If you want to learn more about Jeremy and the practice, well, it's Kyle, K-E-I-L, KyleFP.com. If you add /blog podcast, well, he was doing the Retirement Revealed podcast, but it's been renamed the Retire Today podcast and blog to keep with the book. So either way, KyleFP.com. Again, add /blog and podcast, and you'll get straight there. Jeremy, Kyle, it's great to have you back on Money Life.
Glad to be here to help you retire today.
Well, it's interesting because there is so much of a battle between the soft data and the hard data right now. And the soft data is all these people saying, I don't feel like I've got enough to retire. I don't feel like I'm in good enough shape. And the hard data says the market's at record highs and people have made boatloads of money. So how much of just getting ready to retire today is getting a handle on just how capable you are of accomplishing it?
Yeah, you might be feeling like you can't retire today, but if you actually run through the process, you will know. And maybe you can, maybe you can't, but you're better off knowing. And that's my encouragement, is to follow a process to plan for retirement, find out whether you can do it or not. You might be surprised. I've got a few stories in the book of people who were surprised they could retire before they thought they could.
And I want to start with that because, of course, you and I have met at FinCon. We have talked before, but FinCon gravitates a little bit towards the FI community, the financial independence, and then it's financial independence retire early community. And this is not really a book about financial independence retire early. This is a book about, are you independent enough to retire? And there is a difference, isn't there?
Well, that's exactly it. So when I'm at FinCon talking to folks like you, I say I help people do traditional retirement. Basically, you're 60 years old, you're done with your job, you want to find out if you can retire and do the things that you want to do. Let me help you get to there. Completely different story than if I want to retire at 40.
Let's talk a little bit about what goes into planning, because there is a subset of financial advisors who, for lack of a better term, they basically fall under the label of lifestyle planners. And their idea is always, well, if you tell me that your idea of retirement is I'll buy a little house in New England and run a bed and breakfast and, live out my days with the leaf peepers and having fun that way, their answer would be, what can we do to make that happen right now? For you, does the lifestyle come first in terms of what you envision retirement to be, or does the money come first? Because if it's retire today, it sounds like it's more about the money, but I know from having looked at the book, that's not entirely true.
Yeah, what's interesting, if you talk to a financial advisor, they will usually ask you, how much do you want to live on in retirement? But what's funny to me about that is most people, when they come to me, they ask, how much can I live on in retirement? So that's a big piece of it, is saying what you've already done so far, what could that turn into for income? But I also encourage you to say, what is it you're solving for? You're not solving for, I got $1 million, $2 million, $5 million in my statements. What you're solving for is I do need that to turn into income to create the lifestyle that I want to do. I give some ideas to figure out what lifestyle do you want to live in retirement. I'll give you a hint. It starts with, what lifestyle are you living today? Generally speaking, if you could just do what you're doing today without working, you'd probably like to do that. And so that's the first step, is to figure out what spending do you need in retirement, not how much money do I have, but what spending do I need in retirement. The easiest way to do that is look at your paycheck right now. Usually what goes into your checking account gets spent. And so start with that basic framework. If I'm spending this dollar amount today, I'm enjoying my life and what I'm doing. What can I do to create that paycheck again just without working?
While the book is Retire Today, as I was looking through it, I'm like, okay, well, there's plenty in this book that somebody like me, and probably like a lot of our audience members, does know. But there's a whole lot that these people wish they would have gotten earlier. In other words, retire, when they're not ready to retire today. The book sounds like it's going to be that roadmap for, can you do it right now? But it's really that roadmap for, when is today going to be? How do people pick the today?
Yeah, that's a great question. A lot of people have that number in mind. And I mentioned this in the book, where you've got to figure out what I call your retirement longevity number. It's a bit of, when do you start your retirement? It's also a bit of, when might your retirement end? And all the research shows you've got a number of when you want to retire. And on average, you're retiring 3 years earlier. And so I encourage you to figure out, when do you want to retire, but make sure your plan is ready 3 years ahead of time. You just might be retiring 3 years ahead of time for all sorts of reasons, health reasons. You might have a job change. But sometimes if you're ready 3 years ahead of time, you might just say, what am I waiting for? Let me go ahead and retire earlier than I was planning.
How much of this is also that people don't understand retirement lifestyles? And I say this knowing that, for example, my parents, my dad fought tooth and nail not to move into a retirement community, but eventually he agreed. And when they moved into this retirement community, my dad hadn't lived there for 3 weeks when he looked at me and said, we should have done this 5 years ago, right? It was about the social aspects of it. It was about the, we don't have to care for the big house aspects of it, et cetera. But my father, who could have retired anytime he wanted, my father and mother could have gone anytime they wanted, but he at least didn't fully understand these were the options. How much do we have a problem today where people envision retirement, but they don't fully understand it? They don't, they think of a retirement community as my ex-wife did. She's like, that's a place where people go to wait to die, which was distinctly not what was happening. But she's never going to go to one, and her retirement would be very different than maybe mine, because I might go to one.
Yeah, people don't understand the options. One of the options you have towards retirement is the option to work less and work longer. A lot of people like a bit of their job and they don't like going down to nothing. But then they just have this thought in their head of, I can only be working or only be retired. I just had somebody recently worked in the medical field. He said, I loved my job when I dealt with patients for 40 hours a week. I don't like my job when I deal with patients for 40 hours a week and the paperwork for 30 hours a week. And I said, well, great. Go to your boss, go to your organization and tell them this is what you want to do. He said, Jeremy, this has never happened before in the 100-year history of this health system, where someone in my position has been allowed to go and work 4 days a week and not do the notes, to let somebody else do them. I said, what does it hurt to ask? So he went and asked, emailed me the next day and said, you'll never believe it. I set the record. I've created history. They thought it'd be better to have him around dealing with patients than to not have him around at all. And that was a choice he presented them. If I don't like what I'm doing with my job, but I want to do the things that I like doing with my job. And that was able to help him extend out how long he was working for them, kind of give him a stair step down into retirement. So a lot of the retirement lifestyle options are, how do you transition into retirement? But you're right on too, where if you ask a retiree today, when was the right time to retire? They'll tell you, before I actually did. The retirees today will say, go ahead, retire. And there are a lot of folks, especially I found with widows, where you've kind of lost this social net in a way. And if you go to some sort of apartment complex, condo complex, retirement community, if you want to call it that, where you've got that already built in, they'll tell you as well, I wish I'd done this sooner.
Yeah, because your friends are retiring and they're moving and scattering to the four winds, and life in your house is not going to be the way it has been for all this time, though people do there. And I'll add a story to yours, which is my best friend, who was a doctor. He watched as the two people who he shared backroom functions with, he was a sole practitioner, and they all shared backroom functions. And in COVID, The other guy's retired. And he's like, okay, well, now I don't have them to help pay these costs because that's the part of the work that I hate. He retired then because he said, I can retire early. And oh, by the way, the medical part that he wants, he volunteers. And so now it's perfect. He's like, I don't have to do anything. He goes, I'm a volunteer. They go, how can we help you? And he goes, I get to do exactly what I want. And then I have the rest of the time. And he's, as he points out, he's much busier, much happier, indulging his creative side, et cetera. And that's what we want to see people doing. How much do people also need to be not necessarily locking down their finances, but we see a whole lot where people today, they want certainty. And the market doesn't necessarily give you certainty, or if it does, you pay a high price for it. How much do you say, okay, you have a plan and there's a bunch of different ways to execute it. Like you got a house, you could sell it, put that money into whatever that produces income, or buy the condo in the retirement community, or you could do the reverse mortgage thing, et cetera. How much do you have to decide before you retire, as opposed to entering retirement, seeing how it goes and going, okay, now it's go lock this income down, I'm staying here, versus, okay, I'm going to move or do whatever.
Yeah, a lot of this certainty that you're talking about, you do want to decide this ahead of time, or at least plan it out ahead of time and realize what you want to do. Just because you're retiring a few years down the road doesn't mean you have to wait till then. You can create some of the certainty ahead of time. And I'm thinking of two bits of certainty. One part of it is that the stock market is uncertain. That's what creates the returns, is the uncertainty of the stock market. If you want the certainty, usually you do want that certainty for, I want to know my money is going to show up next month or next year. Well, your short-term money that you're relying on, you ought to put towards short-term type of investments. So I encourage people to stop looking at your portfolio in one and start looking at it in two different buckets. Your long-term growth money that hopefully grows in the long term, but your short-term money, that the money you want pretty soon, find investments that are coming due pretty soon. That's one part of the certainty. The other part of the certainty is how much regular monthly lifetime income do you want showing up to you? Usually that's provided by Social Security. Sometimes you have a pension. And of course, any retiree, you're heading towards 60 plus, you're going to get a lot of pitches about annuities and how great they are. And some annuities could be good for you, but don't start with the thought of, oh, this product will guarantee this certain percentage or thing. You need to start with, well, how much guaranteed income do I want coming in each month? I just had a recent client where she came to me because her advisor said, you should put half your money into guaranteed investments. Her sister, who's an accountant, said, I don't know if that's the right number. Let's go to somebody I trust. And I started with the kind of the backwards in a way, not how much do you put into the annuity, but it's how much income do you need? Well, talking through with this recent widow, she's missing about $1,500 of income because the Social Security dropped by $1,500. And she said, I really liked having that ongoing. I knew what was going to show up in my paycheck into my checking account. And I missed that. I wish I had that. I know I don't have that with my market investments. And said, well, that's where you start then. That's what you need, is a certain amount of income, the amount you figured out you want guaranteed. Then go find some sort of product that fits that best. Don't be going around saying, what's going to pay me 5%, 8%? What's going to pay me the number? Who knows if you actually need it? Figure out first, how much income do you want guaranteed? And then see, am I getting that? A lot of people are getting that from Social Security and pensions. Well, then you don't need anything else. But if you got that gap there, that's where you start. And then you go find something that fits best for you.
Yeah, I like to talk about what I call don't mess it up money. There's a certain amount of money that if you know you have it and you can generate a certain amount of income off it, et cetera, you're fine. And at that point, just kind of make sure that that's taken care of. Don't mess that up. And with everything else, not that I would recommend you buy scratch tickets, but you can do anything you want, up to and including scratch tickets, I guess.
There you go.
When you look at the retirement challenges that people are facing today, there is a lot of talk about how ill-prepared people are. And at the same time, there's a lot of stuff that goes on in the financial planning world that's not bad for clients, but it's really good for financial advisors. And by this, I talk about things like the 4% idea that you're going to spend 4%. Well, okay, but if you never spend down your principal, well, that's a big annuity for the advisor who's getting a cut of that money. And you are feeling your entire working life, I'm not making enough money. I'm not getting to where I get those numbers so that I can live off my 4%. how much do we have to kind of change this and get to where people really understand some of the things you're talking about, but how it truly works so that they're not spending their accumulation years terrified and they're not underspending? Because you work awfully hard for this money, and I see too many people who just don't use it.
Yeah, people don't use it, and economists are wondering what's the deal? Why do people save for 35 years and then they don't spend the money that they've saved? I think where economists get it a little bit wrong is they are assigning absolutely zero value to the good feelings you get by knowing how much money you have, by seeing your account statements go up, maybe even the fear of I'm hurting myself, I'm kind of failing if I take money out of my accounts. Economists need to kind of account for how people actually behave, but also at the same time, people need to realize you probably started with zero. Like you hit your first paycheck, your first time working in your early 20s, you had nothing in your 401k and you've built it up to 500,000, 2 million, 5 million, whatever the number is. If you happen to pass on and have more than zero at the end of time, you're still a winner. It's a-okay to start with zero, build it up to something good, and allow that with a plan to dwindle down over time. What I encourage people to look at is I understand you don't want to spend the principal, but you've used this for a reason. Economists kind of think you should go to zero. You think you ought to keep it exactly where it's at. Let's start with a base point of halfway. Let's try to make the people happy and the economists happy. What if your plan says I've built it up and it is scheduled to go down to be about half of what you have right now? Is leaving half your money to your kids good enough and you spending the rest of it good enough? And they usually say yes.
Yeah. And the economist in me, the economics major in me is totally there with, yeah, you got to be able to use it. That's what you work for. Jeremy, great stuff. Really appreciate you being here. Again, the book is Retire Today, Create Your Retirement Master Plan in 5 Simple Steps. Out now from Jeremy Kyle. Jeremy, great stuff. Thank you so much for joining me on the show.
Glad to be with you, Chuck.
Jeremy Kyle is a retirement planner. He runs Kyle Financial Partners. Kyle, Keil. I'm spelling it so you can find him at kylefp.com. And again, if you add /blog podcast to it, you will find the Retire Today podcast and blog. We're not retiring here on Money Life. Not for a while, but certainly not today. There's much more to go on today's show. Settle back and relax. Money Life will be back in just a moment.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
It's time for the big interview on the October 16th edition of Money Life. And returning to the show right now, my friend Herb Greenberg. You would know him from a lot of different places if you are somebody who pays any attention to the market. He is the editor of Herb Greenberg's Red Flag Alerts. You can find everything he's doing at herbgreenberg.com. And specifically, if you're looking for what he's been doing now, he's got a great new piece out that is looking at the fact that not normal is now the new normal. Since we need to understand normal, well, no one I'd rather talk to than Herb Greenberg. Herb, it's great to have you back on Money Life.
It's always great to be with you, Chuck.
Let's talk about how abnormal this is, because we've got a market at record highs. I've got more and more people going, we're in bubble territory. Bubbles are happening. But the last time I had people saying there was an event happening that we didn't recognize, it was a recession that, has yet to sort of be a recession. So how out of whack are we? How away from normal have we gotten?
This is all obviously a matter of interpretation, and normal is in the eyes of the beholder, or however you want to listen to it. And from my perspective, having done this a long time, what I can tell you with great sincerity is I've been saying that this is not normal all the way up, because you see things happening all the way up. And, you talk about the recession that never came, because people have been talking about, quote unquote, the narrative was the recession for 3 years now, 4 years. I can't keep track of it. The not normal is not a narrative, it's my narrative, but it's increasingly the narrative of so many people who say, hey, we see this happening. We see there's a bubble. Now, is the bubble narrative going to be one of those that we're just going to go to the moon? Well, we never just go to the moon, Chuck. And you're seeing so many people from so many levels doing, maybe it's just covering their own asses, just saying, hey, we know there's a bubble here. And people involved in the bubble are saying, yeah, there's a bubble. And everybody thinks they're smart enough, and they will be smart enough to get out before the bubble pops. That's a classic bubble-esque mentality. And by the way, you saw it back in 2021 with SPACs, where everybody was getting into the act. Everybody was becoming a sponsor of a SPAC. Everybody had to own a SPAC. And then, of course, we know what happened there. And that's just a few years ago. But this time, of course, is different, or so they say it's different. When I say this is not normal, what I've been talking about all the way up, I want to be very transparent about that, because obviously I got it wrong, and I'll continue to get it wrong till I don't. So I'm a broken clock, some might say. But I think what's important here is that when you see stocks moving 10, not just 10%, 40, 50% a day, doubling a day, it's easy for people in options to double, triple their money in a matter of hours sometimes. That's not normal. Not healthy for the markets. It's not normal, but it's what we've come to expect in a world where things have changed rather rapidly. And what I mean by that is, if you look at what's driving the market, everybody will tell you they think they know. And elements of all of them are true. So for example, we've always talked about the algorithms. People more recently, in recent years, talk about the pod shops, the multi-strategy hedge funds, and the impact they're having on the market. Beyond that, you have the gamification of the market, because that's added an entirely new level. There's something we saw in the 2021 period with the meme stocks and everybody going in and just trading like, just because everybody else is trading. And then on top of that, we have the elements of everybody just trying to get in and time the top of this AI thing. We also have South Korea. A lot of people don't talk about South Korea, but the amount of trading on US stocks in South Korea via double, triple levered funds that are, they're buying them, is enormous. And it's a part of the market that I think plays into all of this. But all that said, it's creating this not normal environment. That not normal is the new normal for now, until it isn't.
Does that mean that the advice for the average person is ride along, get what you can out of it until it isn't? How much preparation? Because it's one thing if we go through, the market goes up 30% and then it, drops 20 pretty quickly and you're out, you still came out ahead. It's another if, the bottom falls out and we're going to now be in abnormal and bad times for a while.
Chuck, look, it's all a matter of anybody's individual risk tolerance and what they consider duration. There are people who will buy stocks today, will live through the downdrafts, and will be standing 20 years from now, 10 years from now, say, see, I bought that thing, it went down 80%, and look at it today, it's gone to the moon, if they have that kind of duration and risk tolerance. Human nature is human nature, and it's easy to get sucked into the casino and to say, you want some level of it. So it really comes down to different strategies and how much money someone is willing to put at stake, because it's a speculative part of their portfolio, or how much they really believe in because they genuinely understand the underlying fundamentals and risk and potential rewards of those individual companies.
Okay, so now I'm going to put a normal scenario to you in a very abnormal way. 30 years ago this month was the first ever Society for American Business Editors and Writers, now the Society for Advancing Business Editing and Writing, but the first ever CEBU conference on personal finance. We were supposed to have Jack Bogle speaking there. I know, I organized the conference, but Jack wound up having to cancel last minute because he was actually about to get his heart transplant, got the heart transplant then. He was replaced by a guy named Bill Berger, who ran the Berger funds, which I'm sure you remember, but not many audience members remember. They went, eventually, I think they were sold to Janus and merged out of existence. And Bill Berger came there and he gave a speech that was all about the folly of forecasting. And he literally showed a piece from the Weekly World News of a guy who sadly kind of looks like me at this point, ruminating over a pizza. And it was tell your future in your next crystal ball. And he said, this is about how most forecasts would be. But if you want a good forecast, here's one. And he then said, Dow, 116,200. Now, this was before Kevin Hassett and Jim Greenberg got the idea for Dow 36,000, which took forever. And he put a caveat on it. He said, 2040, And he said, the reason for it is I've been in the investment world 45 years. When I started, it was Dow about 250. It's now about Dow 4,500. And 250 to 4,500 is the same as 4,500 to 116,200. We're now 15 years away from the target. We only need about 6.5%, 7% in the next 15 years annualized to get there. Do we get there? Like, are we looking at times that are abnormal enough that you could look and say, okay, the market's always worked this way and it's not going to work this way?
Look, I'm not a strategist and I'm not a historian on what the market will do. I think that the reality, when you talk about 7% a year for somebody who is patient and willing to live through it, one thing we all know is historically what the markets have done. We know it. It's irrefutable. Whether there's a lapse of 20 years like there was in Japan, good luck trying to figure it out. We're going to be one day away when this airs from the 38th anniversary of the October 17th stock market crash in 1987. There have been a lot of tests since then, before then, but really since then. And as things have evolved and social media and everything has just made things crazy, the markets have gotten faster. They become, I think, a lot less predictable. Technical analysis has made an enormous change since so many people have embraced variations of it and use it to trade, because trading is so important until it's not. So look, do I know what's going to happen by 2040? Well, I can tell you, the only thing I know about 2040 is I won't be alive. But I do know I hope, well, maybe I will be.
I was going to say, I'll take the over on that bet, Herb. Not you should take the over on that bet, but I'll take it. It's only 15 years away and you're in great shape.
I'm in great shape, bud. There was a bit of a heart
I had one of those too.
Yeah. But you never know, right? We never know, especially with medical. Look, I'd be willing to bet that it's going to be a lot higher, but I'm also willing to say that there's going to be a period. And it's the $64 trillion question. And that is, when will the buy the dip will be a dip that you bought, but will not rebound 10 seconds later? That's the part that nobody knows and everybody has an opinion about. But that's the one thing, because that gets to the human nature of feeling, oh man, it's great. I'll be part of this. And if it goes down, it's not going to hurt my life. And then it goes down and you go, oh my God, what just happened? And that's the element that we just don't understand. And, no matter who you talk to, you talk to so many people and they're all smart folks, and other than me, and they all will tell you pretty much the same thing. And that is that, long term, markets have done what the market's going to do. It's a question of how it's going to get there. And there are elements of the world that have changed as it relates to investing, all of which we've seen. And I add social media in there because I think it's an important element to all of this because of the speed of information and the nuttiness that goes on.
As we have changed things, there's been a lot of hue and cry over the Trump administration saying, hey, we're going to let things like crypto, private credit, private equity be allowed in retirement plans. And of course, the hue and cry is all about some individual investors going to go out there, put everything in crypto and blow themselves up. And I'm sorry, I feel bad for that person if they wind up doing it, but I don't feel terrible for them. They should have known better. But the interesting side is the BlackRocks of the world, where Larry Fink not that long ago was saying, crypto was an abomination. And now he's saying everybody needs some, and they run life cycle funds and things along those lines. Is the life cycle fund of the future going to include crypto, private credit, all these other sorts of things? And does that make those folks more susceptible to the new abnormal?
Well, we're in the golden age of grift, as I like to say. So there's a lot of things that go on. And since I've not done any deep dives into crypto, just because I can only handle the stocks I'm researching at any given time, and that takes all my time. Look, I can say, well, yes, all of that will be there. But we can look back in time and see things that we felt should be there, wouldn't be there. And it depends on what blows up and what doesn't blow up. And when they blow up, what people will say about whether that should have been, there should have been more hit regulation. When we look at things like crypto, or we look at private equity or private credit, private credit, I've written, could very well be where you look when you look for what will cause the crack in the system here as it relates to the bubble, rather, for AI, because private credit is funding so much of this. So if there's something between here and there that, whether it's crypto or whether it's private equity or private credit, that causes an event that may change that. But on the other hand, we've seen this all along. Look, you could argue private equity has been tarred, feathered, bashed, beaten up, and it's continued to move on because it's a powerful force in the marketplace. So yeah, I would say, what would Jack Bogle say? I guess he'd say if it's part of a bigger portfolio and it's not going to really hurt you, why not? I guess. I don't know.
I knew Jack very well. I'm not sure. I can't figure out what he'd say. I'm not calling us old because, again, I'm expecting you to actually be here in 2040. We'll set up an interview for it because I'll probably
game.
I'll still be working. Does this not normal situation remind you of past ones? Normally, I'm asking guys who are chief market strategists, what have you lived through where you go, is this 99? Is this whatever? What does this remind you of?
You're always asking yourself that now constantly. And, I've been a guy writing about this, and I've been writing about it. I was writing about it in the 87 crash, working for newspapers. I was there throughout and watching each one of these go. And I remember in the 87 crash, just so you have an idea, I was working at a risk arbitrage firm in New York, and I remember what was going on in the weeks before that thing crashed. And I remember how nervous I was as if somebody gave up a career in journalism to go to the other side. And in those days, it was Gap. People forget the retailer Gap. That was the hottest stock of the time. And when that thing started getting rattled, think about it. We're talking about many years ago when Gap started getting rattled. I'll never forget going up to the partners at the firm I worked for and saying, what are you guys going to do here? And they said, oh, don't worry, go back to your seat and keep working. And that day of the crash, their jaws were on the floors. They didn't know quite what to do. Look, each time stuff starts to move, like back then it was the concept stocks, Gap, or the way Gap moved, going up 20, 30, 40, 50% over a span of time. Each one of these, it's variation on the theme. People always want to say history rhymes. It's all variations, and it just seems to be speeding up. That's the part that's new to me that feels off, is it's speeding up. It's happening so fast. And since 2020, going through to now, we've just had this explosion of traders and speculation at a level I go back to the day traders of the 90s, totally different world, because at least, it was in some context of Bill O'Neill and his approach to momentum investing. Today, again, you've got the gamification layered on top of that. And that's sort of a wild card that we really have to see play out.
Bill O'Neill, who was the first ever guest on Money Life, the first ever big interview guest on Money Life on the very first day of the show.
Right. Bill O'Neill, we should point out, Investors Business Daily, founded Investors Business Daily.
Yes. And the Can Slim method and a lot of the momentum stuff that we've got. I'm curious, when you see new normal being not normal, there are a lot of signs. Are they things like, the meme ETF just came back? And I've covered the ETF world for a long time. I do not know of a fund that failed and then said, wait, let's try again a couple of years later with the same ticker, the same management, and a little tweak to how we run it. But is there your sign?
Those are, again, we look at it, we say, yes, of course, they're seizing the moment. The ducks are quacking, feed the ducks. It's a classic Wall Street term. They're feeding the ducks. The ducks want it. And I think that these are signs. We can all come up with different signs. We're back to the point where you can go outside and everybody's talking about how much and how much money they're making and how easy it is to make money. And it's the old, whichever old analogy you want to use. Yes, we're seeing signs of them. But again, I think you and I have been doing this long enough to know, and I've been doing it longer than you, that the last thing you want to do is be the guy out there that says during the silly season, by the way, which is lasting years, that there's going to be comeuppance. And obviously, you know who I really envy? I envy the people who are really able to put on blinders, not be concerned at all about the FOMO, not getting sucked into it. They're true compounders, and they actually can go in. They know the companies they own. Some of them they'll be right, some of them will be wrong, and they understand the valuations. And that's fewer people than most people. And everything else is a matter of, are you a trader and speculator and you want to feel part of the game and you can talk it? Or are you comfortable with a portfolio that may not be as robust and as exciting and currently 100% above where it was a year earlier? And if it is 100% above where it was a year earlier, the bigger question is, when will you sell? What are your disciplines? And if it falls, will you start feeling horrible? Or do you understand that risk? And what percentage of your portfolio is it? These are all common sense things. I know what my level of risk is. It's very low. And I've, lived it. I've tried it. I've done what I can do. And I understand how I'm not wired and how I am wired. I think the one thing all investors, anyone playing this game, some of them smarter than the other, they all know how much risk they're willing to accept. But the ones who don't will learn it the hard way. And the only way you learn is by learning it the hard way.
The stock that taught me that lesson in my own portfolio, it was Gap.
Was it?
I owned it in the 1980s for a brief time, and I made a bunch of money on it. And I watched and I said, yeah, there's my sign that I need to get out, because a lot of things I learned because I internalized the gain, watched it go down, bought some back later, held it for a while and, whatever. But I learned a lot of that with Gap.
Well, by the way, Chuck, when we talk about Gap and we talk about back then, people forget FOMO is not a new phenomenon. It just wasn't called full of FOMO. There was no you only live once. It was all the same concept because psychology is psychology. It was just something different. It's like meme stocks used to be called concept stocks. Just a newer generation, a newer way of packaging the same term. But it's same thing.
Famously, Herb, in 1988, 89, when I became the business editor at the Morning Call in Allentown, Pennsylvania, I ran a series of columns for a year where I had my cat picking stocks. What I created, by the way, was two different ways to keep the index, one of which was basically price weighted. The other was equal weighted before equal weighting was a thing. And the difference is that today, that would be a sellable product that people would be going, oh, the cat must have known something because the cat beat the market in its 1 year. And today you'd be able to buy that. And maybe that's what normal has become, is in any market condition going back to feed the ducks.
By the way, I should point out that when I was doing television in San Francisco, before I left in 98, in the morning show at KRON, which was the NBC affiliate, I actually did bring a chimpanzee on, and we did have the chimpanzee throw the darts. So, it was, some things never change.
Yeah, no, my favorite iteration of that was the Fort Worth Star-Telegram had a steer named Rusty. I have a picture of Rusty on my desk. And the way that they had Rusty pick local stocks was they put him in a pen that had all the squares, like he'd go to a shopping mall, and all the squares had the names of the local companies. And where Rusty did his business is where he was doing his business. So we've all seen it work in a variety of ways. We're watching it work now, but waiting for it not to. I guess that's the new normal. Herb, great stuff. Thanks as always for joining me. We will talk to you again a long time before 2040, but we're going to book that one and do that.
Thanks a lot, Chuck. Always fun to be here.
That is Herb Greenberg. He is the editor at Herb Greenberg's Red Flag Alerts. Go to herbgreenberg.com. You can sign up for his Substack, do all those sorts of things. Follow him on the social. He is worth it, because I could have asked him a completely different series of questions. We would have had a great interview on something else. But we did the one we did. I'll tell you what something else is coming on tomorrow's show as we wrap up this one right after this message. Stick around at the end.
Hey Money Lifers, it's Rob Floyd, the show's executive producer, and it's time for another contest where you can win a book that was discussed on the show. This week, you're playing for Financial Success for the Rest of Us, Quality of Life Planning for Mainstream America by Dan Dorval, who appeared with Chuck on the October 9th show. And while the book is all about financial success, the contest is all about Major League Baseball teams that have never had success. Tell us 3 of the 5 Major League franchises that have never won a World Series championship, and 2 of them still have a chance at it this year, and you will be entered to win the book. Send your answer to chuck@moneylifeshow.com by noon Eastern Time on Saturday, October 18th to be entered for a drawing to win the book. And please put the word contest in your subject line. Good luck.
We are back to wrap this one up. If my audio sounded a little bit different for you when you were listening to Herb Greenberg, it's because I was recording on a different device, specifically the one that I will be using when I go to see my grandson. Yeah, that's him. When I go to see Declan in December, what my birth gift, or grandfather gift, or whatever you want to call it, when he was born was that I bought myself a new laptop. The reason for that is that when I'm on the road, we can record more easily when we go to an event, I'm recording on a handheld, but we can access the online recording portal, which is about half of our interviews get done that way. The others are done by phone, and we're set up to record both ways. When I go on the road, I cannot record by phone. So we're going to do a couple of tests, and the new mic, it's a different mic, et cetera, arrived, and we were playing around with it. We don't have it all dialed in yet, and we have some issues that have been coming up with my home mic anyway. We haven't been entirely thrilled with our sound quality. Please let us know if and when it's bothering you. But that was a good test, because what we're going to say when I go away in December to see Declan is, hey, we can only record with people who can do it online for that time period. And that's how we'll continue the show when I am on the road. And that's good for the future, because I do intend to be, taking time with Gail and doing whatever. So we've got that, and we got that done. And I appreciate that, hopefully you didn't notice anything. Like, you just thought, yeah, it is what it is. But we may go to a point where you go, okay, I don't like that sound quality for a week or something along those lines. Do let us know. Those issues are really important to us. Trust me, we work hard. Rob Floyd does just incredible work trying to make me sound better, and he needs to, because I otherwise wouldn't sound good at all. We've got another good show for you tomorrow that hopefully will sound great. It includes John Cole Scott from Closed End Fund Advisors here for The Navigator, talking about business development companies. Hedge fund manager Stephen Gray, value investor, will be here for the market call, and there's more coming. So plan to be here. You'll learn more about it. We're moving some things around, doing some stuff. There's a lot of stuff going on. Meanwhile, if you're looking for something to celebrate, there are a lot of things today, and I will point out that some of them are stunningly generic, like, you'll see in here a moment. But we start with holidays that we normally don't celebrate at all, like barely even mention them. And that would be things that have to do with money, like it's National Get Smart About Credit Day.
Unlimited credit. That's what it means. An open charge account with no reckoning.
Yeah, we don't celebrate those holidays, but we tell you about them, but we don't celebrate them because we're doing that stuff every day. We want you to always be smart about credit. But it's also National Cut Up Your Credit Card Day. Yeah, those are the scissors. I don't think it sounds that way when you're cutting up a credit card, but that may be one way to get smart about credit. It is Global Cat Day. I don't think they call it Catter Day, but they could. It's National Dictionary Day. It's National Sports Day. Not any sport, just one sport. It's National Department Store Day. So that's kind of generic and broad, although I love a good department store, and I wish we had more of them, but everybody's doing everything online. It is National Bosses Day.
Don't argue with the boss.
And it's Get to Know Your Customers Day, which happens on the third Thursday of every quarter. It's also Conflict Resolution Day. So get to know your customers, work with the boss, and resolve the conflicts. And then on the food front, again, very generic, it is World Bread Day, World Food Day, and National Liqueur Day, which is not a specific liquor. It's just if you want to get liqueured up.
My advice to you, start drinking heavily.
With liqueurs, maybe not. My guests today were Todd Rosenbluth, head of research at Vetify, vetify.com. Jeremy Kyle, retirement planner at Kyle Financial Partners, will give away his book, Retire Today, Create Your Retirement Master Plan in 5 Simple Steps, next week. But it's Kyle FP, Kyle, K-E-I-L, KyleFP.com. And of course, Herb Greenberg, editor of Herb Greenberg's Red Flag Alerts, herbgreenberg.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho and Stash, my dogs, because I recorded that interview with Herb upstairs where Stash was more involved. Although he didn't sound like that. But mostly thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Stephanie McCullough. She is a financial planner. She's been a guest on the show. She's somebody who I met through FinCon and who I like. And she said, money is never just numbers. It's choices, fears, and dreams. And that's right. Money is about a lot more than just the numbers. That's why you have to keep it in perspective. And to do that properly, I hope you will remember that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Sorry, you're too late.